Hello, and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week, we take a step back from the noise to unpack the key developments shaping credit, look at the macro forces behind them, and discuss what they really mean for investors and issuers across Europe and the UK. Before we dive in, a quick mention. We've just launched our new macro credit microsite on KBRA.com. It brings together all of our podcasts, newsletters, and quarterly reviews into one place. You can find all of my work along with Van Hesser's perspectives at kbra.com/macro credit. Do take a look when you have a moment. It's built to help you keep pace with the macro and credit trends shaping the market. Now, on to this week. It's a full plate from central bank policy signals to European bank earnings, oil markets, and even a fresh debate on securitization. If there's a single theme that ties it all together, it's transition. Europe's story right now is one of gradual, uneven progress. Real growth still looks like a 2026 story, but the data are showing the first hints of recovery. Those little green shoots we've been waiting for are finally starting to appear. So, let's take a closer look. Starting with the central banks, the Federal Reserve is widely expected to cut rates this week, and you can hear all about that from Van Hesser. The European Central Bank, meanwhile, looks set to hold steady for now, while the Bank of Japan remains the outlier, leaning slightly toward a hike as inflation has stayed above target, though not enough to prompt action this month in our view. In short, no major surprises, but still a moment of subtle divergence. Here in Europe, Christine Lagarde has flagged elevated food inflation as one of her lingering concerns, with prices rising just above 2%. For the ECB, this isn't the kind of inflation that triggers a change in direction, but it does reinforce the case for patience. Inflation overall looks well contained, and rate cuts in Europe are unlikely here. If anything, we are likely stuck here for a considerable amount of time, and risks lie to future rate rises, although that is still quite a ways off. So for now, central banks appear to be where they want to be, cautious, data-dependent, and waiting to see if the soft landing narrative holds. Over in the UK, the Bank of England has been making some interesting noises about AI and private credit. Earlier this month, they released their financial stability update, raising concerns about stretched valuations, particularly in the artificial intelligence sector. They noted that despite ongoing uncertainty in the economic outlook, valuations keep rising and credit spreads keep tightening. Then, more recently, they announced a review of lending tied to AI, data center development, and the energy infrastructure that underpins all of this. It's a fascinating intersection because while AI has mostly been an equity story so far, the lending and financing side is starting to come into focus. The bank is clearly trying to get ahead of potential risks, especially if the scale of AI-related borrowing starts to expand over the next several years. Now, to be clear, it's still early days. Europe's own AI infrastructure build-out has been slow to materialize compared to the US and parts of Asia, but it is a healthy sign that regulators are tuned in early, watching for any spillover from the hype cycle into the credit markets. As far as financial stability is concerned, awareness at this stage is a good thing. However, in our view, they should be focusing more on the sectors that will see AI disruption and the potential impact on those credit markets. Now, let's move to the banking sector, where earnings season has given us a fairly mixed picture, but one that leans positively. HSBC raised its full-year outlook, helped by a slower pace of expected rate cuts, particularly from the UK. Barclays reiterated its expectations for 2025 and 2026, though it did take a hit from its auto finance exposure, specifically from Tricolor, which led to fresh provisions and a review of its loan book. Lloyds faced auto finance pressures from the ongoing loan commission compensation legal actions, but remained confident in its 2026 guidance. And NatWest reported strong earnings with relatively benign impairments. Across the channel, the results were more varied. BNP Paribas saw a more challenging quarter with increased loan provisions, including one undisclosed issue from its markets team. UniCredit, on the other hand, had an excellent quarter driven by strong trading income, and its CEO even hinted at the potential for a profit upgrade. UniCredit also continues to benefit from its strategic holdings in Commerzbank and Alpha Bank, though investors are watching closely for any signs of a bank tax coming out of Italy's 2026 budget. And in the Nordics, the big names Nordea, Handelsbanken, SEB, and Swedbank all reported solid results, but noted some softening demand and persistent concerns in commercial real estate lending. Now, despite the generally positive tone of earnings, the ECB's bank lending survey, which also came out recently, tells a slightly different story, showing a mild tightening in lending conditions. Geopolitical uncertainty and risk aversion are prompting banks to be a little bit more selective, particularly on corporate loans. Interestingly, demand from corporates remains relatively subdued, focused on refinancing and restructuring rather than new working capital or inventory financing. That's a subtle but telling difference from what we're seeing in the US, where corporate capex appetite has picked up a bit more aggressively. On the household side, though, there is some strength. Mortgage demand has increased as borrowers look to lock in lower rates. It's one of the few bright spots in an otherwise marginally cautious credit landscape. Now, let's turn to energy, where last week's conversation about oversupply in oil markets is continuing to play out. According to the International Energy Agency, global oil markets are likely to remain in surplus well into 2026, despite new sanctions on Russian crude. For Europe, that's something of a double-edged sword. On one hand, lower oil prices help European corporates by keeping input costs down, particularly in manufacturing and logistics-heavy sectors. But on the other hand, it adds pressure to those associated with the oil industry, particularly the oilfield services industry, which is already navigating the region's accelerated transition towards renewables and natural gas. A recent case in point, Petrofac, a UK-based engineering and oilfield services group, has applied to enter administration. While this move isn't directly caused by current oil prices, it highlights how challenging the operating environment has become for companies that are straddling both the old and new energy worlds. As Europe continues to wean itself off Russian energy, with the 2027 deadline for full diversification drawing closer, this tension between low prices and low investment is likely to persist. As KBRA highlighted in a recent note, the connection between oil prices and the European economy is decreasing. On the macro front, the data picture is slowly improving. Last week's PMI results showed gains across much of Europe. In Germany, the composite PMI rose to 53.8 in October from 52 in the prior month, another sign that expectations are turning more positive in the region. The Eurozone overall remains above the key 50 threshold, which signals expansion, and the UK is also in growth territory. The outlier, once again, is France, where PMIs remain below 50 and decline slightly. That said, there's a nuance here. A separate manufacturing business confidence survey in France actually ticked above 100 for the first time since 2024. That's significant, suggesting that pessimism in order books is easing and that production prospects are starting to improve. It's a reminder that recoveries rarely move in straight lines, and sentiment often turns before the hard data catches up. While we're on the topic of France, let's touch on the fiscal picture. France continues to wrestle with its 2026 budget, and it's proving politically fraught. Under EU rules, member states must submit budgets that align with national fiscal frameworks and are reviewed by the European Commission. So far, Paris hasn't been able to get there. The left is pushing for a wealth tax, while conservatives want deeper spending cuts, and neither side seems ready to compromise. Even under the rosiest assumptions, France is unlikely to hit the 3% deficit ceiling target, though the Commission may still approve its submission if there is a credible path toward reduction. If not, France could be forced into remedial procedures, where the Commission requires corrective action plans or imposes financial penalties. That would be an extreme outcome, but it's worth watching as the year-end approaches. Finally, a topic that's been around for decades, securitization. It has resurfaced in the financial press, most recently in a series of Financial Times articles. The debate, in short, centers on whether securitization risks are starting to rise again, echoing some of the concerns that preceded the global financial crisis nearly 20 years ago. Industry veterans were quick to respond. Mark Rains of Major SecReg reminded readers that securitization isn't some modern invention. The tranching of risk in cash flow structures dates back centuries. And Sean Baddeley from the Association for Financial Markets in Europe pointed to how the market has evolved since 2008. He noted that over 40 years of data show that default and loss rates on higher-rated securitization tranches are broadly comparable to other forms of credit. In other words, the data doesn't support the idea of systemic risk in today's market. We'd agree with that assessment. Europe's securitization framework today is heavily regulated and structurally different from the pre-GFC era. There are other areas of potential risk that probably deserve more attention. Just ask Andrew Bailey over at the Bank of England. So, where does that leave us? Geopolitical concerns are fading, though not gone. Yields remain high, and defaults have yet to truly emerge, particularly in Europe. Banks are tightening slightly, but growth is showing those first genuine signs of life. Concerns are rising about financial stability risk, but they may be looking in the wrong direction. Broadly speaking, it's a picture of cautious optimism for Europe, a market that's cautiously watching the strong enthusiasm for new technology in pockets, while the real economy is slowly regaining its footing after a long period of adjustment. That's it for this week's edition of the Credit Compass. If you found today's discussion useful, follow, rate, and share the show. It really helps others to discover it. And if there's a topic you'd like us to explore, drop us a line. We're always open to listeners' ideas. For deeper insights and data-driven analysis on macro and credit trends, don't forget, visit kbra.com/macrocredit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass guide your way.